Many traders are unsure about how to recognize when a trend changes direction in the forex and stocks market. But actually, spotting trend reversals is not difficult. Often, they are very clear and easy to see. So why do traders still find it confusing? The reason is that they tend to make it more complicated than necessary. Let's simplify things and clear up some of the confusion. So, let's make it simple to understand trend reversals. We'll go back to the basics and not worry about things that aren't important. Instead, we'll focus on making money. In this video, you'll learn a simple 5-step way to know when a trend is starting to change, when to take action, and how to make the most of it. So whatever your trading strategy is, these 5 steps should always be there, and you must master them very well. Let's get started. Step number 1. Spotting the trend. Before we start thinking about trend reversals, let's make sure we actually see a trend first. It might sound a bit silly, but sometimes we get so excited about reversals that we forget to see if there's a trend in the first place. This is common among forex and stocks traders. We tend to rush things. So, let's begin at the beginning. That means, let's not rush into finding trend reversals before we confirm that there's a trend happening. Here's the key thing to remember. Keep it simple. Don't complicate things or get lost in the details. Clear your chart of all those indicators and make it neat. Zoom out to see the bigger picture. If you see a clear trend on the screen, then you're on the right track. Look at this image and ask yourself if there's a trend and which way it's going. Seems pretty obvious, doesn't it? What about this situation? If you have to get really close, squint your eyes, and feel confused, then there probably isn't a trend there. So, if you can't clearly see a trend on your chart, try a different trading option. There are so many markets available to choose from. Keep searching until you find a trend that you can easily see on the screen. Step number 2. Choose your indicator. Now, in step 2, let's decide which indicator you want to use for spotting trend reversals. By this point, you should have found a market that seems to be trending. Now, it's time to look more closely. We need to add some information to the blank chart. That means we can add some indicators or look for patterns on the chart. Indicators and chart patterns can sometimes overwhelm traders. When they hear the word indicator, they might feel confused with so many choices. There are many different indicators, lots of settings, and endless combinations. It can be too much to handle. But here's the important thing. The specific indicator you choose for spotting trend reversals doesn't matter so much. They're quite similar. I know this might sound surprising in the trading world, but it's true. So, relax and take it easy. You don't need to stress about all the choices. Just pick an indicator that you feel comfortable using. No need to worry, there's no right or wrong choice. Each indicator has its own advantages and disadvantages. You can use any of the following indicators or patterns to identify a trend reversal. You won't go too far astray with any of these options. First, pay attention to a change in the pattern of highs and lows. Market trends usually move in waves. These waves are often called higher highs and higher lows, or lower lows and lower highs in a down market. If you see a series of higher highs and higher lows in the market, well done, you've spotted a trend. When this pattern stops, the trend usually stops too. Pros. This is one of the oldest and most commonly used methods to find a trend. Cons. Sometimes, it can be hard to see this pattern in real markets. We'll talk more about how this pattern finishes in a bit. Second, wait for a break above or below a moving average. You can also use moving averages to help you see when a trend might be changing direction. When you use certain moving averages, it's like having support from big traders. Imagine the 200-day simple moving average. It's a number that many big banks and fund managers pay attention to. If a market drops below this 200-day moving average, it's a significant sign. It suggests the trend might be ending and even turning around. Another method is looking out for moving average crossovers. Many computerized traders use these to track how a trend is doing. For example, they might watch a 20-day moving average and a 50-day moving average. When one of these crosses over the other, it's a signal. Pros. You can feel more confident because you're seeing the same thing as the big traders. Cons. Moving averages can have trouble when the market is uncertain or volatile. How to use the half-trend indicator for trading. Let's understand how the half-trend indicator works using an example on a British pound United States dollar 1-hour chart. The indicator gives us arrows to signal when to buy or sell. For a buy situation, first, the price needs to go above the indicator. Second, the indicator should be in blue color. Third, a blue arrow signal should appear from below the indicator. For a sell situation, first, the price should be below the indicator. Second, the indicator color should be red. Third, a red arrow appearing will confirm the sell signal. Once you confirm the entry and make the trade, you can hold the position and follow the trend until you see the opposite signal. To manage risk, for buy positions, set a stop loss below the previous low. For sell positions, set a stop loss above the previous high. This indicator is great for both new and experienced intraday and swing traders. It's easy to see when to enter and exit trades and how strong the trend is. The best part is, the arrow signals are accurate and don't change afterward. This makes it a reliable tool because it doesn't repaint signals. If you need this half-trend indicator, you can download it from the description area of this video. I've provided a template with the system that you can easily upload to your chart. It will automatically plot all these indicators accurately on your charts, so you don't have to worry about anything. Get the download link in the description. Step number 3. Spotting the trend reversal. Now that we've identified a trend and have an indicator or pattern suggesting a trend might be changing, let's move on to the third step out of the 5 steps. We're getting serious now. But what's a trend reversal event? It's a specific situation that, once it happens, lets you know that a trend might be reversing. You can't just figure this out on the spot. You have to decide what it is beforehand. If you wait until the market is moving quickly and you have money at stake, it'll be hard to make clear decisions. Here are some examples of trend reversal events for each of the indicators we talked about earlier. Higher highs and higher lows. A trend reversal happens when a candle closes below the last higher low. This means the trend has changed. Moving averages. If the 20-day moving average crosses the 50-day moving average on the daily chart, that's a sign the trend is reversing. Also, if the half-trend indicator changes from blue to red, it means the trend is reversing. Step number 4. Time to act on the trend reversal. The specific event we agreed on beforehand as a trend reversal has occurred. Now, it's the moment we've been waiting for. The signal you've been waiting for has shown up. And now, it's time to take action. Traders often spend lots of time planning what to do when a certain event happens. But when that event actually occurs, they hesitate. They start doubting themselves, adding more indicators, checking different time frames. Basically, they talk themselves out of acting. If you're already in the market, this signal might mean it's time to close a trade. But if you're waiting to enter a trade, it could be the right time to open one. Remember to use price action patterns for entering a trade and make sure to set your stop loss first. Believe in your analysis. If you've reached this stage, chances are you're onto something good. Have faith in your analysis, trust the chart, and take action. Step number 5. Stick to your plan. This is the most important step. Now you've pretty much learned all you need to know about recognizing when a trend is changing in the market. First, you can see a trend. Just let it stand out on the screen. Second, you've got an indicator or pattern that signals a possible trend shift. Third, you have clear criteria to tell when the trend is done. Fourth, you know to take action, trust your analysis, and either start or finish a trade. That's pretty much everything you need to know. It's not tough. But here's where you can mess it up. Step 5 is all about staying consistent. The worst mistake is not sticking to your plan. In this Trader DNA channel, you can learn many trading strategies. Take your time to learn each one carefully, as all these strategies are reliable. Once you find a trading strategy that suits you personally, make sure to master it well. The next crucial step is to consistently apply the trading rules of that strategy. If you have a few trades that don't go your way, don't start changing everything. Don't add more confusing indicators or adjust their settings. Instead, combine basic trend analysis with good risk-to-reward trades, and you've got a strong strategy for trading. That's all you need. And as usual, if you picked up something new, remember to subscribe, hit the notification bell, and give us a thumbs up to show your support. See you next time.